Hello, welcome back. Okay, suppose you observe the following asset returns, volatilities and correlations. How can we apply the CAPM to find the appropriate discount rate for the firm? So a few things to note. First, we have a correlation table. So firm I is perfectly correlated with firm I. The asset returns are perfectly correlated. Notice the firm I is more correlated with its local market and less correlated with the world. Okay, the next thing that we have are our volatilities, our standard deviations. Notice that firm I is more volatile than the local market, and the local market is more volatile than the world. And then the very last thing, our expected returns. We've got our discount rate, which is what we're going to solve for. And then we've got the discount rate or the expected return. We've got our expected return for the local market and the expected return for the world. Okay. Assume the risk-free rate is 5%. Using the table from the previous slide, calculate the beta of the firm with the local market and the world. So what are you going to do? You remember your beta equal to your correlation multiplied by your volatilities. So the standard deviation of firm I, the standard deviation of the local market, divided by the variance of either the local market or the variance of the world market portfolio. So, okay, just to do things from the perspective of the local market first, we've got our beta. So what do we have? Our correlation multiplied by the volatility of the firm, the volatility of the local market divided by the variance of the local market, the standard deviation squared. What do these betas measure? So as you set this up and as you solve for it, remember that your beta is telling you how a 1 percentage point increase in the expected return for the market increases or decreases the expected return of firm I. So if firm I had a beta of 2, we would be saying that a 1 percentage point increase or a 1% increase in the expected return for the market, we would expect a 2% increase in the expected return for firm I. If firm I had a beta of negative 1.5, we would be saying that a 1% increase in the expected return for the market, we expect to have a negative 1.5% decrease in the expected return for firm I. Suppose the company were segmented from global capital markets and therefore priced locally. Use the CAPM to estimate the firm's discount rate. Okay, so hopefully what you'll observe is that if the firm is priced locally, it will have a discount rate that's based on its local CAPM. For part 4, when we want to apply the CAPM globally, same intuition, same idea. What's different? Well, what's different is we would have the beta for the firm with the world market portfolio multiplied by the market risk premium for the world market portfolio, the excess return for the world market portfolio. Okay, hopefully as you solve this and as you work through it, what you'll observe are very different discount rates for the firm. Example 1 shows that we can lower the cost of capital with global diversification. The intuition is that though the betas with the local and world market are the same, the world market is better diversified. Our betas are given. So as we add more foreign assets to our portfolio, we expect to diversify. We expect to reduce risk, holding constant expected return. Why? Well, correlations. When asset returns are not perfectly correlated, we can benefit from diversification. And this is especially true globally. This is true in any setting. In any setting, whenever there is less than perfect correlation between assets, we can always diversify. We can always find a diversification benefit, especially true globally. Let's take a look. So what am I showing you? I'm showing you from 2001 to 2019 annual returns for Argentina, Germany, and Japan. Observe that the markets are not perfectly correlated. There's large differences in annual market returns across the world. Therefore, as an investor, I can benefit from diversification. There's some years where one market is way up and another market is not. So I can mix and match. I can create a portfolio that exploits these differences in market returns across countries. Why would financial markets have less than perfect correlation? Well, obviously, we have differences in economic and political activity. We also have differences in investors' preferences. So let's just look at one of those factors. The figure to the right, or rather to the left, shows that there are differences in economic growth and business cycles across the selected countries. So you can see that in 2019, in Argentina, there was an extensive recession. In Japan and in Germany, we see slight expansions. So the punchline is that we have differences in economic activity across countries. We also have different industry structures, goods being produced, means of production, different resources, different trade environments, different labor markets, different political and cultural institutions, and so on, all that lead to differences in how financial markets perform across countries at any given point in time. So if we have these differences in performance, meaning that in any given point in time, one market will be really, really up and another market will not be, what does that tell us about the correlations? Well, hopefully that tells us that these markets are going to be less than perfectly correlated. Let's take a look. So this is an exhibit from chapter 15 of the book. It's a cutout from this Journal of Finance article written by Yoon and Resnick. What's the key takeaway? Notice how if you look across, so let's use the United States. If you look across the United States, you can observe that there's large cross-sectional differences in correlation. So you can see that the US has its lowest correlation with Japan and its highest correlation with Australia. Okay, so what's the big takeaway? The big takeaway is that because we have these differences in correlation across countries, we also have the opportunity for large diversification across the world. Okay. So the previous figure shows that there are opportunities for diversification across countries. The variation in correlation across markets indicates that globally diversified portfolios should have lower systematic risk. Let's say that again. Because there is differences in correlation across markets, if I create a globally diversified portfolio, I should be reducing my systematic risk. Since less systematic risk implies lower expected returns, we would expect that capital markets in which investors are more globally diversified should have a lower cost of capital. So firms in markets where investors are more globally diversified should have lower discount rates. We can test this prediction by examining the relationship between the implied cost of capital, discount rates, and how globally diversified investors are in different countries. To do this, we'll need a measure of global diversification. So we're going to use the home bias, which we'll explain on the next slide. We can also examine the performance of globally diversified portfolios, which is what we'll do in our next lecture. Okay, the CAPM predicts that investors hold the market portfolio because it's well diversified and efficient. So we'll examine that in more depth in our next lecture. But for now, let's take it as a given. Okay, since investors would benefit from having a globally diversified portfolio, it follows that investors would hold the world market portfolio to be globally diversified. What does holding the world market portfolio mean? Holding the world market portfolio implies that the weight of any market, including your home country, would be equal to that country's weight in the world market portfolio. So if your country has a weight of 2% in the world market portfolio, When I look inside of an investor's portfolio, you would expect stocks and bonds from that country to occupy 2% of that total portfolio. In practice, this does not happen. In practice, people tend to hold far more local securities than diversification theory would predict. That is, investors show a home bias in their portfolio holdings. For example, US stocks represent around 50% of the world market portfolio, but account for roughly 90% of the holdings of US mutual funds. So this figure is showing you the share in the world market portfolio, and then the share of the proportion of local equities that domestic mutual funds invest in. What do you observe? Hopefully you observe that despite all of these markets having a considerably smaller share of the world market portfolio, investors in each of these markets overweight their domestic securities relative to the weight of those securities in the world market portfolio. Australia is responsible for less than a 2% share of the world market portfolio, but Australian domestic mutual funds invest nearly 80% of their capital into Australian equities. So this is astounding. This is the home bias. The previous table shows considerable home bias in equity portfolios of many countries. That is, investors overweight domestic securities relative to the world market. So investors around the world hold far more domestic stocks and bonds than our diversification theory would predict. Why would overweight domestic securities be such a bad thing? Well, as we recall from slide 10, when there's less international risk sharing, investors require more compensation for bearing more systematic risk. More compensation for bearing more systematic risk means they require larger discount rates. So it raises the cost of capital. So we would expect firms within these countries to face a higher cost of capital, right? That higher cost of capital means you have lower firm value because you're using a larger discount rate, and you have investments that are not profitable because those investments don't go past the internal rate of return necessary for them to be positive NPV. So remember, we shrink the discount rate, we increase firm value, and we can potentially increase investment because there'll be projects that before weren't positive NPV projects. But now, with a smaller discount rate, those projects might be positive NPV projects. Okay, so what do we observe? We observe that in countries where investors have higher home bias, firms have a higher implied cost of capital. So there's this strong positive relationship between the discount rate and home bias, which is what we predicted. If investors are less globally diversified, they bear way more systematic risk, and in exchange for bearing this higher systematic risk, they require more compensation in the form of a higher discount rate. So the figure on the previous slide shows a strong positive association between home bias and the implied cost of capital, suggesting that discount rates are higher in countries in which investors are less globally diversified. This home bias has been shown to be a local bias as well. So Koval and Maskowitz 2001 show that US mutual funds not only concentrate their holdings in US stocks, but in stocks that are geographically close to the fund headquarters. They find that the average fund manager generates an additional 2.67% per year from her local investments, defined as holdings within 100 kilometers of the fund headquarters, relative to her non-local holdings. Meaning, if you look at the typical US mutual fund, and again, we said these US mutual funds are way over invested in US domestic stocks relative to what diversification theory would predict. It's even worse than that. The set of stocks that they outperform in are the set of stocks that are very locally close to them, that are geographically proximate to the fund headquarters. So the Koval and Maskowitz result suggests that fund managers are exploiting local information advantages to select well-performing nearby stocks. In other words, information is costly. And this kind of helps to provide a demand side explanation for the home bias. A way to think about this is that the true return for holding a stock would be the expected return minus the information costs, where the information costs would be lower for local stocks. A way to wrap your head around this is, you know, that some information, some soft information, like is the company well managed, is the local industry shrinking, etc., it's very difficult to verify, but it might be easier to observe locally. So if you're a local investor, you may have an information advantage. You may have access to this soft information that's kind of tough to prove, but you know it when you see it, and you kind of use that to inform your portfolio decision. This is very similar to the pros and cons of holding stock in the company that you work for. So we discussed this quite a bit when we were looking at corporate governance as a means of incentive alignment. But there's also a big trade-off of diversification that you face if you hold stock in the company that you work for. Here's the trade-off. I reduce diversification, so if the company fails, I lose my stock and I lose my job. But I know way more about my company than I know about other companies. So I have an information advantage, but I'm also having a diversification trade-off. The positive relation between the home bias and the implied cost of capital suggests that the lack of global risk sharing makes capital costly. So why would investors behave this way? Well, there are demand side barriers to foreign investment that are important. There's information costs. So if it costs more to get foreign information than local information, all things held equal, these foreign assets become more costly, so I'm going to be less inclined to hold them. There's also familiarity bias. It's not that we have better information, but we're more familiar with local firms in our city, state, country, etc. And as an investor, I'm going to be comfortable holding something I'm familiar with. The last several ones, there's uncertainty aversion. So here, it's not that investors have better information, and it's not that investors are more familiar. It's that investors think of foreign stocks as being riskier than local stocks. So you can think of this as investors think that a foreign stock has a higher volatility than the local stock. You think it's riskier than the local stock. Other explanations are that you might have to hedge and manage local risk. So domestic inflation, political risk, my consumption risk. I'll need a portfolio of assets that's exposed to these local risk factors. And I'm not going to get that same exposure with non-local assets in the same degree. So I end up holding a lot of local assets to hedge my local risk. There are many other factors that on the demand side have been used to explain home bias. One that I find particularly compelling is patriotism. So there's strong evidence that patriotism deters foreign investment and increases overinvestment in domestic bonds. That was a cool paper by Pradkin in 2016. So the big point is that there are many demand side factors that limit foreign investment. There's information costs, familiarity bias, uncertainty aversion, the need to hedge local risk, and many other factors that can reduce investors' willingness to invest in foreign securities. There's also supply side limits to foreign investment. Not all securities may be investable to foreign investors. Investability is so important when we talk about global capital management and asset allocation. Can foreign investors actually buy and sell these shares? The availability of shares may be limited due to explicit restrictions on foreign investment. So Governments in developed and developing countries all around the world will limit the level of foreign ownership for certain sectors of the economy. There's also the free float. So again, within dedicated portfolio management and capital management, the question will always be, well, what's the free float? Market capitalization you're familiar with. The free float adjusts the market cap for shares being limited because they're closely held by founding families, large shareholders, and governments. If you remember when we discussed corporate governance, we said there's a twin agency concern because we have large shareholders who own a lot of the company, again, because information is costly. So one of the ways of internalizing this information externality is by having a large share of the company. So we have this twin agency concern that we're worried about managers, we're worried about the large shareholder, awesome, so on and so forth. What that means for home bias is that because we have these large shareholders that are holding large chunks of the company's stock, there may not even be shares available for foreign investors to actually come in and buy the firm. So on paper, there's a lot of equity, a lot of bonds that are available globally, but in reality, there's only a fraction that might be available. This is why we care about the free flow. And then obviously liquidity. Does the security trade? Does it trade daily? Does it trade weekly? Does it trade once a month? This is not trivial at all. If you are an investor who's doing dedicated portfolio management, if the security, the stock or the bond barely trades, how are you going to buy it? And if it barely trades, what's going to happen when you go to sell it? You're going to face a large, steep discount when you go to sell. So that liquidity is a very real factor. Restrictions on foreign investment. As we mentioned, governments all around the world impose limits on foreign investment, and many are sector specific. So banking, defense, infrastructure, oftentimes these will be decided as areas of the economy that are strategically important or have national security interests. Here's a very recent example. So the restrictions are generally used to ensure domestic control of local firms, especially those that are considered strategically important for national interests. An example that I just keep coming back to is TikTok. In December of 2020, the US Pentagon ordered military personnel to delete TikTok from their devices. However, mobile security experts were pretty clear that the user agreement for TikTok, not that different at all from any of the data collection that are found for many of the other apps that are on people's iPhones and Androids, etc. So what's the punchline? The idea is that because we have these restrictions on foreign investment, as a foreign investor, I have a limited supply that I can actually invest in. So the home bias can be affected by these restrictions on foreign investment. How do we overcome all of this? Well, we're going to cross list. With equities, we can cross list. We're domiciled in country A. We list on the exchange in country A and on country B. What does that mean? Well, in doing so, we can reduce the cost of capital by accessing global investors. So in other words, we can go to foreign capital markets to lower the discount rate plus raise capital. We discussed cross-listing within the context of corporate governance when we talked about bonding theory. We're thinking about our debt. So if we go back to that WACC, if we go back to our weighted average cost of capital, remember we've got the return on our assets equal to the evaluated return on our equity and the evaluated return on our debt. Okay, so with equity, we can cross-list, and in cross-listing, it's awesome because we get access to investors who really aren't in our local market. Because they're not in our local market, they're not bearing or being exposed to the same cash flow risk that they would be if they were in our local market. That diversification means that they have a lower required return for holding our firm. When it comes to debt, so think about the return for debt from that weighted average cost of capital. With debt, you're going to be trying to take advantage of differences in borrowing costs across countries. And this is something that is especially true for multinational corporations. As a multinational corporation, if you have operations across the world, you have operations in different countries, those assets that you have, because of the inability to enforce bankruptcy laws, often across borders, having those assets in different countries is going to allow you to essentially issue debt backed by those assets. So you can kind of time or take advantage of differences in borrowing costs, debt borrowing costs, especially across countries, which is something we'll talk more about when we get into international bond markets. So let's do an example. Using the table below, assume the risk-free rate is 5%. Suppose that the firm has a perpetual cash flow of 30 million USD. Using the CAPM, calculate the market value of the firm if it were priced globally. So you've got the expected return from the market. You can very easily calculate the market risk premium because you're also given the risk-free rate. With that market risk premium and the beta and that risk-free rate, you've got everything you need to calculate the discount rate for the firm's cash flows. So you plug it in, you find that discount rate, and then you're going to value this as a perpetuity. You've got 30 million USD that are going to be perpetual cash flows. So it's very straightforward perpetuity problem. Okay, using the CAPM, calculate the market value of the firm if it were priced globally. So same steps. Instead, now we're going to apply the beta of the firm to the world market. We're going to use the world market's excess return, plug it back into our CAPM, and we'll find our discount rate. What is the maximum price that the owner of the firm would pay to cross-list? In other words, what do you observe as the difference in firm value between the firm being priced locally and the firm being priced globally? The big picture. We've priced firms locally and globally. Applying the CAPM, discount rates change as a function of access to non-local capital markets. In other words, we can lower the discount rate by accessing global capital markets. Globally, there are ample opportunities for diversification. Capital markets are less globally integrated than we expect that they are. So they're segmented. Investors exhibit a home bias, meaning they overweight domestic stocks and bonds relative to what our diversification theory would predict. And this can be driven by the demand side, by investors' preferences and unwillingness to hold foreign assets. Remember, we said this could be driven by information costs, familiarity bias, uncertainty aversion, and then also other factors like hedging local risk or my consumption risk or patriotism, or lots of different things can affect how we feel about holding foreign assets. And then also on the supply side, there are explicit limits on foreign investment. Investability is a really big factor. The free float, we may not even have shares that are actually available because they're all being tightly held by founders or by a government or by a large shareholder. And then also liquidity. The shares themselves may not even trade enough. The bonds may not even trade enough for a foreign investor to get their hands on. Okay, we said this home bias, this limited global risk sharing raises discount rates as investors require more compensation for bearing more systematic risk. And we saw that. We saw that in countries with higher levels of home bias, there's a higher implied cost of capital. The very last thing is that we discussed corporate strategies to overcome segmented capital markets. So our big example is cross-listing. We observed that when the firm was able to access global capital markets, it faced a lower discount rate, and that lower discount rate increases firm value. Remember, if you can reduce that discount rate, you raise the present value of the firm, and potentially you have investments that are now more attractive. So potentially the firm can invest more. Our next lecture will also be within portfolio choice. We're going to construct the global portfolio. We'll talk a little bit about anomalies. So these are things that shouldn't really happen in the market, but do happen in the market within an international context. These are very interesting. So we'll look at twin shares. We'll look at the phenomenon of pricing to market. And then lastly, we'll discuss limits to arbitrage. Where are we headed? We'll examine style portfolios to open up the risk factors that matter to investors. So when we get into constructing our global portfolios, the next thing we'll do is ask ourselves, okay, if we have these anomalies, are there other factors that might be important to investors? Then we'll move into fixed income and bond portfolio strategies. And our final topic will be valuing currencies. So we'll look at different FX strategies based on our expectations of simple things like inflation. Okay, so we've covered quite a bit of ground, and hopefully you have a good understanding of how that discount rate, where it comes from, how to apply it, and how we can lower it.